Are you thinking of leaving the UK to pay less tax? Well, you're certainly not alone. Increasing number of entrepreneurs from the UK are leaving due to higher taxes, more red tape, lower quality living standards in the UK, and ultimately they're choosing sunnier, safer, and more tax efficient climates to base themselves. So if you're looking to move overseas but you're not sure on where to start, the best way to do this, then watch this video because I'm going to break it down step by step what you need to consider if you're looking at moving overseas in 2025 to pay less in tax. In this video, we're going to cover reasons for leaving the UK, how different income streams, salaries, dividends, rental profits are taxed when you're non-resident, how you actually officially become non-resident, what's the conditions and the criteria for this, how long can you spend in the UK based on your circumstances, the temporary non-residence rules. A lot of people don't know about these, and if you get the temporary non-residence rules wrong, you could face a massive tax bill if you come back to the UK within a certain number of years. And on top of this, taxes if you do come back to the UK, so you've made money overseas but you're coming back, how is that taxed? We're going to touch on inheritance tax as well. A lot of people don't fully understand that moving overseas, moving your residence overseas doesn't necessarily save you inheritance tax, but we're going to touch on some ways that you can actually save inheritance tax by moving overseas, how to get set up overseas, Dubai free zone companies, visas, what do you need to know? And a lot of people, they don't want to stay tied in one place. So what happens if you're a tax resident nowhere? You spend a couple of months in multiple different countries. What does this mean for you and your taxes? And then practical steps to make sure that your move overseas to pay less tax in 2025 goes smoothly. So the first place to start really would be, why should you consider moving overseas in 2025 to pay less in tax from somewhere such as the UK, which has previously been a fantastic place to live? So the first place we'll start is taxes. The UK has some of the highest tax rates in the world, up to 45% on income in the additional rate band. Plus, when you go over certain thresholds, you lose your personal allowance, creating effective tax rates far in excess of 60%. You've got corporation tax. Top rates of corporation tax are actually 26.5% in the marginal profits threshold, but most people paying 25%. You've got increase in capital gains tax. Basically, for a business owner, for an entrepreneur, for a wealthy individual, taxes in the UK are just going up and up and up. And on the flip side of this, you're getting a lot less than you previously were 10, 20, 30 years ago. Policing budgets are being cut left, right and centre. Crimes go unsolved and answered. The police do not care for the vast majority of crimes. The NHS waiting lines are getting longer than ever. There's continuous underinvestment despite taxes going up, which ultimately means for any wealthy entrepreneur, for any wealthy taxpayer, it's just not a good return on investment paying taxes in the UK for what you get. On top of this, you've got the cost of living crisis. The UK is getting more expensive. Prices are going up across the board. You've got high interest rates and so much more. Actually, the UK just isn't the attractive place to live that it once was. What are the benefits of moving overseas? Well, they fall into a couple of different categories. So for me, the biggest benefits are taxes, absolutely. If you base yourself somewhere overseas, Singapore, UAE, Malta, you are certainly going to be saving money in taxes than what you're currently paying in the UK in most cases. On top of this, freedom, an active lifestyle, a bit of sunshine. That's what these countries typically have to offer. And of course, safety as well. So for a lot of people, I myself love Dubai. Spain's a good location as well. Of course, you don't really get any tax benefits being there unless you go under the Beckham law. But you get a fantastic lifestyle, 360 odd days of sunshine or whatever it works out at, fantastic tax savings, and you can actually have nice stuff. You can leave your apartment door unlocked. You can drive a nice car without it getting stolen. And that, for me, is why anybody who's got nice things, anybody who's making decent money should definitely be exploring moving overseas, just as I have done and I've helped hundreds of clients do the same as well. How are different income streams taxed when you're non-resident? So for the purpose of this, we'll assume that you're tax resident in the UAE because a lot of people watching this will be, and in my experience, most wealthy people that are relocating overseas, the main place they are going is the UAE. Complete honesty, you've got loads of other different options, whether you've got different tax rates, Malta, Cyprus, Singapore, Beckham law, and of course each of those will have different caveats to it. But the good thing about the UAE is the taxes are pretty simple over there. 0% income tax, 0% CGT, 9% corp tax. So that gives us easy figures to work with. So the first thing we'll consider is dividends. A lot of people have a UK company already set up, already established, that they want to keep in the UK, and that's fine. That's absolutely manageable. And then usually what they'll do here is they'll pay themselves dividends out of their UK limited company. So the first thing to mention there is that that company will probably remain UK resident. You might have offices, other directors, staff in the UK. So that company will continue paying corporation tax on its profits. Then as you're a non-resident, you'll be able to extract your dividend income completely tax-free. It does get a little bit complicated in terms of how that's actually achieved, because there's something quite technical called the disregarded income rules. We won't jump into that in detail because it's kind of way above most people's heads, and actually it's not entirely relevant in that you will actually get your dividends tax-free in the vast majority of cases. But essentially the way they work is if you've ever got other UK taxable income, such as rental income in your own name, they'll calculate two tax liabilities, one tax on all of your UK income including the dividends, one basically excluding the dividends and just your UK source income, and then they'll take the lower of the two. That's in essence how it works. But for most people, you probably don't have rental properties in your own name anymore, but if you do, expect to be paying a little bit of tax on those if you're taking significant dividends because your personal allowance won't be available. Another way that people can actually take money from their company and minimise their UK corporation tax liability is to pay themselves a salary from their UK business to the UAE. Of course, anything that you do when it comes to tax planning has to be market value, arm's length. It's got to be reasonable. You can't just suddenly move overseas and pay yourself a £500,000 salary from your UK company when you haven't previously done that before, and it's basically overinflated to try and secure a tax advantage. HMRC will challenge you. So anything you do has to be arm's length. A lot of people miss that one, but that is absolutely crucial if you want to keep on the right side of HMRC. So with this salary, as you're non-resident, there won't be any UK income tax on that unless it specifically relates to UK duties, but you're living overseas, so that won't be the case. However, for the first 12 months, there will be national insurance due if your UK company is paying you through the payroll for the first 12 months you move overseas. But that's it. That's a fantastic way to pay yourself. And of course, what a lot of people do as well is they might set up a company in Dubai, one of the easiest ways to get visas, and then you can potentially look at charging management charges from the UAE to your UK business in exchange for the services that you genuinely do render for the UK business. The good thing about that is it usually isn't subject to national insurance, and you can utilise the free zone company that you've set up and move the money across. As I mentioned, everything's got to be arm's length, it's got to be market value, it's got to be well documented. You need agreements written up to make sure that HMRC are happy with the arrangement, because if they're not, they will basically hit you with a massive tax bill, some potential fines, and it just won't be good from a tax perspective. Just want to pause the video here. If you're enjoying this video, please do smash that subscribe button and give us a thumbs up. I don't know if it helps at all, but I'm told it helps the video get out there in the algorithm and hopefully get some more views. Back to the video. What about rental profits? How are they taxed? Well, if you've got a portfolio of properties in your own name, they will still be subject to tax in the UK. Any form of UK situated asset, usually the profit from that is still taxed in the UK, even if you're non-resident. That's different to if you've got a salary, if you've got a dividend, potentially interest income. That isn't taxable in the UK in most cases because it's not physically located in the UK. We mentioned the disregarded income rules, but most of the time, especially if you're taking significant dividends, you won't have your personal allowance available to offset against your rental property income. But as long as it's not more than, say, £50,000, you won't be paying more than 20% tax. It'll just be the basic rate tax that you need to pay on those property profits. And remember, if you are living overseas, you need to register as a non-resident landlord with HMRC. They usually have the tax withheld by your letting agent or your tenant, and you can apply to HMRC to get gross payment status and basically get the full rent if you're registered with HMRC and got a good standing on your account. So there we have it, guys. That's how the different income streams are taxed. Basically, dividends tax-free if you live in Dubai, salary tax-free except for national insurance. But if you've still got property in the UK, there'll be some income tax to pay on that in most cases. If you're looking to find out more about moving overseas, I have just launched my brand new Tax Smart Club, and this Thursday we've got a live training session covering everything we've gone into this video and a lot more detail. The opportunity to ask your questions and have them answered by me live on the webinar. If you want to find out more about this and get inside now and start paying less in tax the right way, click that link below and sign up now. back to the video. And of course, the big one, how about crypto? So you build up a significant crypto portfolio, you're thinking about moving overseas because you want some gains tax-free. Well, the good news is in the UAE, there's no capital gains tax. So when you sell your crypto, you can do it completely tax-free, saving up to 24%, which is what you could be paying if you sold them whilst you're in the UK. You do need to watch out for the 5-year anti-avoidance rules that we're going to cover in the next couple of minutes though. Okay, so we know that moving overseas can bring some significant tax advantages, as we've just seen, all the different income streams being potentially tax-free if you're located in Dubai. But how do you actually go about achieving this? How do you become non-resident? It's actually pretty simple in the UK. A lot of different countries, they have more kind of vague, abstract tests where it's all about your place of habitual abode or where are your centre of economic interests. But the good thing about the UK Statutory Residency Test is it's pretty simple to follow, and it's all about number of days in the UK, reason for being overseas, and potentially ties as well. So there are 3 different tests that you need to be aware of. The first one is the automatic overseas test. And for a lot of people moving overseas, this is probably the best way to qualify as being non-resident. Without getting into a huge level of detail, usually you can be non-resident under the automatic non-residence test if you spend less than 16 days in the UK without any other reason for being overseas, or if you work full-time overseas abroad. Now, this is how a lot of our clients secure their non-residency status, because they've got a UAE company set up that they're doing business through, they've got a full-time employment contract, and they genuinely do the work overseas, working full-time, no significant breaks from employment of more than 31 days, which is what's required in the granular detail. And this allows them to spend less than 91 days in the UK. As long as they don't go more than 90, you can be non-resident by working full-time overseas, 90 days in the UK to keep it safe. And as a result, you will not be tax resident in the UK. That is the best way to ensure that you are 100% non-tax resident. You've got the automatic UK residency test as well, which we won't go into, but a lot of people often confuse the sufficient ties test and kind of start worrying about, oh, okay, I've got a property, I've got a business, I've got a family in the UK, what does this mean for me? And actually with these tests you work down. So the first thing to consider and try and aim for if you are moving overseas is, are you working full-time overseas? Are you spending less than 91 days a year in the UK? Fantastic, you are overseas. You can still have a main residence, you can still have family, still have investments in the UK. It doesn't matter, because you've hit that first hurdle of working overseas, less than 91 days, that's it squared off. But if you do potentially want to spend more time in the UK, or if you're not working full-time overseas, then most likely you'll have to look at the sufficient ties test. And what this does is it looks at the number of ties you have. Usually the main ones that impact people are having a main residence, being UK resident in the previous 2 years, having a UK resident family. A lot of people think that having businesses in the UK, it does count as a tie, but it actually doesn't for the sufficient ties test. It can do when we're looking at domicile and where you're subject to IHT, and actually if you've actually genuinely left the UK. But for the sufficient ties test, that's not relevant. So usually what you do is you count up all of your ties. You might have 2 or 3. Look at the chart under the statutory residency test, and what it does is it tells you that, okay, if you have 2 ties, you'll be non-resident if you spend more than 90 days in the UK, whatever it works out at. And it's pretty simple. You just follow the chart based on the number of ties. If you want to spend more time in the UK, try and drop some of the ties. After a couple of years of being a non-tax resident, you can actually use a different kind of chart that's available in the statutory residency test, the arrivals chart rather than the leavers. Then that gives you more days, less ties, and basically in some cases we've helped clients after being non-resident for a few years, very few UK ties. You actually spend up to 182 days in the UK without triggering a tax residency, as long as you've got the very few ties and you've not been UK resident for usually past 2 or 3 tax years. So the 5-year rule, what is it and why do you need to worry about it? So the 5-year rule is technically called the temporary non-residence rules, and it's basically just that. So it taxes people on income or gains that they've tried to save tax on by being temporary non-residents. So the way to get around these rules is to basically make sure that you leave the UK for a long time. At least 5 full tax years is what's required to make sure that this income's tax-free. And this is the main type of income and gains rather, that are subject to this 5-year anti-avoidance rule. So we've already touched on crypto. If you've got a crypto portfolio now that might have cost you £1 million, now it's worth £3 million, you're thinking about going to the UAE for the next tax year, you're going to sell it and come back after 1 year, you're not going to pay any taxes. Unfortunately, that doesn't work, because as that £2 million of gain it cost you 1 million, it's now worth 3, you've got a £2 million gain roughly. As that gain accrued whilst you're a UK resident, if you then sell it whilst you're non-resident and become UK resident again within those 5 full tax years, that gain that accrued whilst you're you're a UK resident will actually be taxable in your year of return. The same's true of dividends as well. So if you've got a company that's got £1 million worth of retained earnings and you think you should go overseas next year, wipe the company out, take those tax-free dividends and come back, doesn't work like that. That 1 million of profit which was earned whilst you're a UK resident, subject to the 5-year rule. So if you come back at any time within that 5 years and trigger a UK tax residency, you will pay the full amount of tax on that in that tax year you return. Other income caught by this might be pension payments as well, but for most clients what we see is capital gains and dividend income. So if you do want to secure a tax advantage by moving overseas and you've got basically dividends built up in a company already or massive capital gains, you need to make sure that you can leave the UK for 5 full tax years. Otherwise, on the year you get back, you'll be hit with a massive tax bill. And so you might be looking at coming back to the UK, or you certainly want to keep the option open. You don't want to be hit with massive tax bills if you get back to the UK. So what taxes do apply should you come back to the UK? And this follows on nicely from the 5-year rule. So assuming that you've either done more than 5 years overseas, so you know your CGTs cleared, or your dividends from your pre-departure profits, they're cleared out. Assuming that you've built up significant wealth or you've just been earning a salary and you want to come back to the UK, how does that work? What happens with the money that's sitting in your overseas bank account from being non-resident? What happens to that? And the good news is that has already been taxed in the tax year it was earned. So just because you might have £1 million sitting in your UAE bank account, you can actually come back to the UK whenever you wish and bring that money over with you, and there's no further taxes on this. And this is really what's quite powerful about a lot of people that are moving out to Dubai, because they realise this is an insane opportunity to actually build significant wealth in your own name. Usually in the UK, people just take £50,000, £100,000 out and just leave so much money sitting in their company because they can't really afford to pay the taxes, they don't want to pay the taxes, so they become very wealthy on paper, but personally, they're not cash rich whatsoever. Their businesses they might have lots of investments, but they just don't want to take it out because they'll be paying 45% taxes and it just doesn't seem worth it. Whereas in the UAE, the flip side is the complete truth. So that you can take out pretty much all you earn. There's no income taxes, so you start to build a lot of wealth in your own name. And then after 5 or 10 years of hustling, growing the business, working, you've actually got a couple of £1 million sitting in your own personal bank account, not tied up in a company. All that money's been taxed at 0% most likely. And then you can come back to the UK with that and actually invest it, live off that for the rest of your life. What we've had clients doing to great success is come back, start investing in property. They've got £2 or £3 million sitting in their current account. They could put that in as a director's own account. So that company can now purchase properties, leverage them, get fantastic cash flow. And then they've got a £3 million director's own account, which they can charge interest on, very tax efficient, and also draw down for pretty much the rest of their life. £250,000 a year for the next 12 years, they can take out of that property business without paying any income tax. So they've lived in Dubai, not paid tax for the past few years, and now because they've built that wealth up in their own name, put it into a company, they can also get a further decade or so of tax-free living just because of the wealth that they've been able to build up in their own name. And now, we spoke about inheritance tax earlier and how actually there is a lot of misconceptions around moving overseas and inheritance tax. And the reason for this is domicile exists completely separately from your residency. It's a lot harder to lose your domicile than it is residency. Residency is all days based, as we've seen here. You're in the UK, less than 91 days, work full-time overseas, live somewhere else, work there, fantastic, you're resident there. But actually, you can still be subject to UK inheritance tax because that's all about your long-term intentions. And if you're UK domiciled, your entire worldwide estate, so if you've got properties in Dubai, Cyprus, companies, stock portfolios, crypto, all of that is up for grabs if you're UK domiciled. So it's very important if you do want to reduce your exposure to IHT that you plan for this very, very carefully. It's not just a case of going overseas for a year or two, still having businesses, friends coming back to the UK often, because HMRC, they've won lots of cases that are loosely based around those types of facts. So you want to make sure if you do want to cut ties to the UK and cut your domicile, you need to not really have any businesses in the UK, no properties, friends and family. You're not coming back to visit them. You've got new social circles in Dubai, wherever you're based. You've got businesses there. And basically, they want to see that the fundamental true roots of your lifestyle have moved. So you can't have it where you've still got ties to the UK, you're still based here. They go as morbid to say that, where are you going to be buried? If that's the UK, you've still got family here, you've still got my property here, the chances are you'll be UK domiciled. Whereas you really want to be going this great extent. Okay, so do you have a will in place? Do you have the funeral arrangements for where you're going to be buried? Because these can all be persuasive factors in determining whether you are UK domiciled or not. And if you want to avoid that massive 40% IHT bill, you want to make sure that you're not UK domiciled. And of course, it goes without saying that any UK situs assets, so properties you have in the UK, they will still be taxable to UK IHT, whether or not you have an overseas domicile when it comes to your date of death. So, getting set up overseas, what are the best options? With Dubai, the UAE, there are quite a few fantastic options, and the reason I like Dubai to get a visa is it's just so much easier and more straightforward than most other countries. We're looking at Spanish visas. It takes 5 to 6 months to get a visa. Lots of headache, lots of kind of being present in Spain, lots of back and forth that you wouldn't get in Dubai. With Dubai, you can actually get a company set up, get a visa within 10 days, 2 weeks maximum, and off the back of that, it'll be a 2-year visa. After that, you might be able to get a 10-year golden visa to further document your intention to stay in Dubai for the long term. You can get a golden visa if you buy a property over 2 million dirhams, and it's just so much easier to get set up. So for most people looking to move to Dubai, the best option is usually set up a free zone company with yourself. If you've got wife or children, you can sponsor them off the back of your visa. And then what that company will allow you to do is potentially have management charges to your UK company to save that national insurance. You can start conducting business through your free zone company. You can set up a Stripe account, start getting paid in dirhams, and start earning money through your UAE business and saving tax. Now you're living and working in the UAE rather than the UK. Why have the UK business? Why not move the entire business to the UAE and save that corporation tax and get your visa off the back of it? Getting a business bank account out in the UAE is relatively straightforward. You've got the likes of WEO, RAK, Mashreq. These are all pretty decent banks to be working with. Relatively straightforward to get set up. Of course, you've got a few hurdles in terms of it's a little bit harder than the UK, but in the whole grand scheme of things, it's a relatively straightforward process. You can get multi-currency accounts, euros, dollars, GBP, AED. So it's very easy to conduct business internationally once you're set up. And then the last point, so, what if you're tax resident nowhere? A lot of people say, Dubai's too hot, Josh. I can only be there 2 or 3 months of the year. I can't be there 6 months to trigger the tax residency in the UAE. You have to usually be 6 months in the UAE to trigger your tax residency there. Less than 3 months in the UK to avoid a tax residency there. But you might want to go to a few different countries, 3 months here, 3 months there, a couple of months here. What happens to my taxes in that case? And in this case, if you're a full-on nomad, it's actually completely possible to be tax resident nowhere. You don't spend long enough in any single country to trigger a tax residency. And the impact of this is basically the same as being taxed in Dubai in that you do not pay any taxes. You are international nomad. You don't stay long enough in one single country to pay taxes. So as a result, you don't pay taxes. Pretty straightforward. So there we have it, guys, a whistle-stop tour of what you need to know when leaving the UK to make sure that you do it correctly from a tax perspective. Of course, don't just watch this video and go ahead and do it yourselves because there might be quirks, there's a few technicalities that might be involved, so do work with a specialist. UK taxes are hard enough, throw in some international tax matters, and that is enough to confuse 99.9% of accountants, so do work with a specialist. If you do want to work with me to structure your move overseas, click that link below now, book a call with myself, I'll run through your circumstances and see exactly how we can help you.